Okay, week. Well, it's actually week 4. Why is this thing saying? Yeah, week 4. It's going to be chapter 5. So chapters are. We do more than one chapter a week. Anyway, tonight we're going to be talking about banking stuff, interest rates. Again, banks, as I kind of tried to impress upon you before, it's all about having your money work harder than you are, and a bank, and interest rate. It's it's almost laughable. I mean, they pay you an interest rate, good on them, but you'll see that it's roughly about one half of what inflation is. And oh, by the way, it's taxable. So it's just, you're not going to generate wealth keeping your money in the bank. Um, Lots of things you can do, maybe whatever. And I'm not saying you got to get, you know, and I'm not encouraging speculation. I'm not saying throw it all in crypto or do something like that. But anyway, you've got to take sort of a longer term look. Even with a bank, if you invest for a longer term, say a 5 year or something, you can get a better rate than you can get um, on a short term type thing. They call those, sometimes certificates of deposits or whatever. It's all marketing. They can call them whatever they want, but there's some accounts that have restrictions on them in terms of how quickly you can get access to your money. And it's not the end of the world. If you need access to the money because of some emergency, you can get it. You'll probably just forfeit the interest, or there'll be some sort of penalty associated with it. But, you know, you had a plan, you tried to stick with it, and something happened. So, anyhow, okay, so types of financial institutions. These guys are going to get really wrapped up about all these different, banks, savings and loans, and credit unions, and all that is just sort of blurred. You all are probably more attuned to current banking than the authors, because you whatever, whether it's Alaska USA or Northrim Bank or whatever, they all kind of do the same. Was it First National and some of the other ones? You're generally after what's the most convenient, what has the best fees, and what is kind of the least hassle. Because banking should not be your investment type institution. It's more for convenience and getting the transactions done and not costing you a lot of money with silly fees. For money, for wealth generation, you're probably going to have, well, if you're truly going to use wealth generation by its strict definition, you're making money. You're gonna probably be associated with a mortgage bank or something like that. So anyway, the broad class depository institutions, commercial banks. So you also get confused too, because you hear about some banks like Lehman Brothers, or other some of these big banks that some of them are gone, some of them are still around, but J.P. Morgan and some of these banks that do these commercial, big corporate, banks based in typically New York, maybe Boston, but they do a different service. When they say commercial banks, or when they mention commercial banks, I'm thinking of some of these banks that don't deal with retail customers. They deal with big corporations. But anyway, you can define it a number of ways, and it's not all that important. What is important is that you have a bank that's useful to you, that doesn't charge you a lot of money, and provides the services you need so that you can, live your life. And you can transfer money, hopefully, back and forth between your other institution, because I think you're probably going to have one of those, like I say. Good thing about regular banks is, yeah, up to 250,000. Federal Depository Insurance Corporation. Actually, I got to spell that right there. So some safety. So saving institutions, or thrift institutions, you just call them thrifts. Anyway, all this stuff got deregulated, and we're talking a long time ago, Reagan era. So 1980, I think he was elected. We're talking 40 years ago. They need to get with the thing. So Credit unions, yeah, if you worked for a credit union and you got down in the weeds, you'd probably find out there are differences between the two. You know, they call them shares or, shareholders rather than account holders. But for you at the retail level, it doesn't make a lot of difference. What you're concerned with is what they're going to do for you. Finance companies. Finance companies, they sound like something you'd be interested in terms of personal finance. Probably not. The reason why they're out there is because they make highly profitable loans for themselves for people who can't afford, can't be financed by other people's. Generally, especially like with car loans or something like that, when you see a institution that will make a loan to anybody, that's not what you want because those people represent huge risk. Their likelihood of default is quite high, whereas you hopefully have conducted your life to where you have a very low likelihood of default and therefore deserve a better rate. If you go to some car place or whatever that's going to make loans to anybody, they're going to have to inflate their costs to cover the deadbeats, and hopefully that's not you. You want a very specialized institution. USA used to be a great bank. They're not so much anymore, but when they started, they only insured officers, and not even all the military, just the officer class, which means that officers, if you get in trouble, you'll get thrown out. You have to have a college degree to be eligible in 99% of the cases for officership. So you're dealing with college graduates that can't get in trouble. What a great group, in terms of risk to be associated with on finances. So their insurance used to be considerably cheaper, and their, bank rates used to be better. Now they've broadened things. Now you see them advertising. They'll probably advertise at the Super Bowl and other things, and they've kind of, there's still a lot of military people who stay with them, but competitively they're all right, but they're not what they used to be back in the long term. Securities firms. So this is kind of what I'm talking about. Securities and brokerages, and we'll reference them. So these would be typically, you're not going to find these located in Alaska. I think TD Ameritrade has a branch down on Old Seward or something, but it's not that useful. Most of the time, these guys are where you want them to be, near the financial markets, because you're going to be investing, and that's where things are done. You don't necessarily, you want to go to them for investing rather than them come to you. They're not necessarily advertising their convenience to you. It's more about wealth accumulation, that's what you want them doing. You don't need them to be, holding an office open in Alaska hoping somebody comes. That's a lot of overhead. Anyway, insurance companies. So insurance companies are always trying to get into the finance business. Problem is that the returns on most investments done through insurance companies aren't competitive, and they'll say, oh, whatever, and most insurance products come with salesmen. Salesmen charge commission, so again, that's money that's coming off of your account. Your intent is to make money, not to pay money. Especially, most of these commissions are front loaded, which means that they come off your initial investment. So going back to our example of compound interest, if you take a commission from the very first money you deposit, that's the money that's going to be affected by compound interest the most, and that's the money that's being depleted out of your account to pay a commission for something you might have been able to do yourself. So anyway, and investment companies very similar to brokerage. So again, we're kind of splitting hairs between investment companies and brokerages. Financial conglomerates. This is kind of where everybody falls now. But, whatever, they can fire me if they like. But Bank of America may do everything, but do they do anything well? maybe not. Citigroup, a big mega. Anyway, I generally find that the big specialty companies. I got nothing against big companies, but you know, sometimes you spread yourself a little too thin, and I want somebody whose core competency. And it's there's objective measurements you can use for this. You know, if you're looking for, say, mutual funds or something like that for, you know, financial type things, I'll go with a company that's getting the best returns and has the services that I want at the lowest fee. If that happens to be Bank of America, great. But most of the time, you know. Anyway, I know if I called, I've got various accounts through Fidelity, TD Ameritrade, a bunch of other folks, and the one that I would dread calling is Bank of America. It's going to be painful. So just for that alone, for customer service, I want to deal with somebody who can address my problem quickly, and I can get on with my day and not get lumped in with some phone tree that's going to go on for quite a few minutes. So anyway, or hours. How financial conglomerates serve individuals. So again, yeah, you have these big companies that can do everything, and again, maybe, you know, especially since we're in tax season now, it would be nice just to get a few documents. And if they're doing everything for you, I'm not trying to steer you away, but again, these companies need to earn your business. That you owe them nothing. They need to provide a service to you. And so if one big company can do it all for you, great. If not, you've got options. So checking accounts, paying your bills on time, all that kind of stuff. This is where these, you know, local banks or local credit unions or whatever, this local presence is quite convenient. You know, you get a check and you can walk in there and deposit it. Now mobile deposits, pretty slick. My business bank is actually a company called Novo. Again, I'm not shelling for these guys because they're good today. They may not be good, you know, by the summer, but last summer they were fantastic. And just, I don't even know where they're located, nor do I care. But in terms of mobile deposit, just slick. Just, you know, the checks went in from the businesses that I have that primarily do business during the summer. And the fact that they weren't local was not a big deal. Change was kind of a hassle. If I got a lot of small bills or things like that, it is kind of nice to have a local bank, but I still have a local bank only because my account number ends in 11111. I'm just the odds of that happening again, so I won't cancel that account. But you know, I pay $5 a month to this local bank just to have that account number that's all ones, and it was purely by coincidence. So anyway, checking accounts are where you're going to do a lot of your transactions, and it's just it's about convenience. It's about, you're not expecting to make interest off this money. You're expecting to have a good relationship so you don't get hit with fees, you don't get hit with penalties, and the ability to transfer money back and forth to your brokerage company or financial services company is paramount. As long as they can get that done, but having a lot of money, a big chunk of money in your checking account, that's kind of at risk. You know, I've had situations happen where you know, a local bank, for example, I had an $18,000 deposit because whatever. It wasn't the circumstances, I would not have agreed with it. And they took the money and then called me afterwards. Whereas with one of the brokerage companies, that could not have happened. So I literally keep minimal money in banks, just enough to pay the bills and get things done and have some overdraft protection. Monitor account balance, checkbooks as you write them. Checks are already sort of going away between Venmo and things like that, or checks that are done as sort of direct ACH debits out of your account. I think in your lifetime you'll certainly see checks probably going away. And reconciling your balances, it's incredibly difficult. When you've got a debit card, you've got other debits coming out of your account. good luck with that. You need to have some sort of overdraft protection, but you more importantly need to be able to keep track of this electronically, because there used to be a concept where there was checks that floated, where you cash a check and it took a few days before it cleared at the bank. Now things almost always clear instantaneously, which means there's no longer a float. Back in the day, I you know logged a few pilot hours flying checks around because it was worth it for the banks to pay, you know, excessive charges to a pilot to have them fly checks to a central bank, because they would, be able to get their money quicker. Now that everything's done digitally, electronically, it's no longer a problem. So this is float, and this is just not something that really happens anymore. Deters fraud. More importantly, though, gets these people their money as soon as possible. And as soon as they get it, they will start earning interest on it. They'll have it invested. So, yeah, so their stuff is getting dated. This is almost 20 years ago now. Credit cards, yep, offered through companies. Debit cards, so debit cards go right against the checking account. For teenagers, could be. The deal with credit versus debit is, as long as you pay your credit card balance every month, you're what they call a convenience user, and you don't accrue any charges. Also, the consumer protections for credit cards are typically stronger in terms of if something flaky happens or if there's fraudulent charges. The laws are quite well established for credit cards. Plus, there's also, and it actually, I guess if you wanted to call that a float, where it takes a few days before that merchant gets your money from the credit card, whereas debit cards, it's typically a little quicker. So here, if you notice some fraud on a credit card, you can call that credit card company and get those charges canceled, and you'll probably have better luck than with the debit card. So, all depends. Some people like debit cards because they can't run them up. You can't overspend. There's only as much money as in your checking account, but if you have a little self-control, that's not as big an issue. Safety deposit boxes. If you look at Anchorage, whatever, 300,000 people or so, there's not 300,000 safety deposit boxes. So the safety deposit boxes, you also have to pay a substantial fee, or whatever, maybe it's reasonable, but for most people, a gun safe, preferably something fireproof, is maybe a better option. And then ATMs. If you're getting charged fees by your ATM, you should find a new bank. Or if you're having to drive across town to go to the bank that's in service, whatever. I haven't paid ATM fees in years, and it's not that difficult. My bank, in fact, my primary bank that's actually based in Texas, whatever my ATM charges are, they just refund them directly to me, regardless of how much they're charged. So, if you're paying ATM fees, you need to find a better bank. Cashier's checks. What happens when you write a check and you let's say you're selling something, because this is where cashier's checks come up. I sold a tractor to a guy, and he gave me a cashier's check. And so it's almost the same as cash, because what it means is that when that person went to the bank to write a cashier's check, well, the bank writes the cashier's check, and the bank puts a hold on the funds in that account in the amount of the cashier's check. So if you've got a cashier's check in your hand and there's no forgery or anything involved, then you can be assured that the funds are there. Whereas if somebody writes you a personal check, is it going to bounce? Is something going to happen? This is kind of where I had a falling out with one of our local banks, where I took them a cashier's check for that tractor that I sold them, and they said, we're going to have to put a hold on this for 3 days. And I said, no, you're not, because those funds were already obligated, and they were just, doing what they could because they can. And anyway, so I closed everything with that bank and went to a different bank and explained the situation. They said, of course, yeah, the money is available instantaneously, and it's a no risk to them. So again, you have to be very careful with you know, not all banks are the same, is what I'm saying. Money orders, kind of a thing of the past. I get one of these about every 10 years because that's when you got to get a new passport. And passports, the State Department for some reason likes money orders. But other than that, these are something used primarily for what they call unbanked people, people who don't have bank accounts. So it's, you could, whatever, you get one at Walmart or you can get one at a post office. But you're going to pay a bit. I think they're like less than $1 at Walmart. Maybe they're a couple bucks at the post office, but you give them the money and then they write you this money order, and it's just a lot of work. You're going to burn a half an hour for a lot of silliness. There's better ways to get money transferred around, but some places insist upon travelers checks. These are for people who don't travel, pretty much. I've been to places where I've had a credit card and I've had tourist people with, I think it was in Turkey or Syria or somewhere, and the people had a check or a traveler's check and they wouldn't take it, but they were happy to take my credit card. So I don't know any application for traveler's checks anymore. Again, kind of a relic. So selecting the financial institution. So this is going to be your homework assignment. You'll see in there and again, this isn't in the book. Don't, people, I know I'm going to get a few emails this week. They can't find this question in the book because it's not in the book. Okay? This is just about you picking maybe 3 or 4 banks, one of which is your current bank. And I'm not trying to get you to, burn your bridges with your current bank. You may like your bank because you've always banked with them, which is a valid reason. But anyway, make sure that they're still the best in terms of fees and convenience and everything else. And deposit rates and insurance, I absolutely don't care because I'm not keeping money in there for interest. I do care about fees, and I do care about things like mobile deposits. And again, this gets back to fees. The ATMs, not only the locations. I want whatever ATM. Pardon me, and I want it now. Other things with banks too, you may notice that they don't mention if you have anything that's direct deposit. Some banks, I can tell you, many of the local ones, like let's say you've got some kind of government check that's going to come to you on the 1st. Most, I know on the military side, they pay on the whatever within a few days of the end of the month. Some of the local banks will actually wait till the 1st, which is, again, just kind of a scam. They've got your money. Clearly the bank in Texas or the banks, back in Virginia, they got the money at the same time, but because they know it's competitive, they get your money to you, as soon as they get it, where at least I know a couple of Alaska banks tend to hold on to it for a day or two. So that might be something to consider. So interest rates, yeah, we'll look at those certificates of deposits. So these are where they're kept to maturity. So again, if they can keep a time frame or make a minimum amount, we have to, invest a certain amount. Maybe they'll give you a little higher. So, but again, this is, you're not going to be making tremendous amounts of money. So they talked about, let me roll back one, risk-free rate. You'll see some rates between banks that are quite low because there's no real default risk. The rates that are offered to consumers are going to be a little higher because there's a little bit of a premium assessed because there's a difference. So anyway, loan rate, financial institutions loan money at a rate higher than they pay depositors. Go figure. So that's where banks make money. They bring in your money and they pay you, a couple percent, and they basically rent it back out at, double that percent, and maybe charge a few fees along the way. So, but anyway, this individual poor credit history pay higher rates. So when you see, some car places may do this for, where they have some sort of low teaser rate that you may qualify for if you have good credit. But if you go in there with some sort of, you know, poor credit score, or God forbid some sort of default or bankruptcy, yeah, you're not going to get that rate. So they can change that. Impact of the economy. Yep. So the economy is pretty poor right now, and so they're not more willing to invest. So this is where they're saying, well, people will take riskier investments trying to make money when, anyway, slow and steady for the majority of your money is kind of where you want to be. But you have to be outdoing the inflation rate, or else you're losing money. Comparing interest rates. Anyway, it's kind of a no-brainer, though. Keeping large sums of money in a bank or a savings institution is just not a sound strategy, because number one, the money's at risk from identity theft type things, and then also just because inflation, where it's going to be eaten up. Term structure. So U.S.-based securities, there's very little risk there. If you invest in T-bills, T-bonds, any of those type of things, the amount of interest that you're paid equates, or should equate, to the amount of risk you're exposed to. Investing in the U.S. government is not a risky proposition, at least not viewed as a risky proposition, so therefore the interest rates are not very high. Investing in a corporation, or especially like, on the extreme, some sort of high-tech startup, that is risky, and so you should be paid a very high premium. But you don't want all your eggs in one basket. You wouldn't want to put all your money in high-tech type things. But anyway, shifts in the yield curve. Again, we'd probably go online for that, but changes. Loan rates. You can look now with the power of the internet. You can go to sites, bankrate.com or other things, and see what the rates are nationally. And so it's forced lenders or institutions that are paying you interest to be more competitive. The monetary policy. So the Fed tries to control the money supply, but obviously during COVID it was out of control. So the Fed will buy and sell securities to try and control interest rates, but for the longest time they were just pumping money in there, and so that has created some inflation that we're now dealing with. So the Fed uses the money supply in the banking system, so they're trying to control the interest rates. And so right now, because interest rates are high, interest rates have not decreased, firms, you see companies laying people off, you see companies not wanting to expand, and that's not where we're at. Things are not improving right now. So right now, the interest rates are being pushed up to try and rein back in inflation. So a lot of stimulus spending, whatever, attributed to COVID. But anyway, just a lot of money being spent. So again, banking is a utility. It's just something that's a tool for you to use to manage your money, to keep your liquidity. It needs to, be easy for you so that you can concentrate on other things. It's not going to be where your wealth is going to be generated. Interest rate, again, a lot of times don't care. Interest rate on mortgages, quite important. But again, it's not going to vary that much amongst the institutions. Interest rate charged on personal loans, yeah, that will greatly affect things. Fees charged on, you're going to have to pay those, so try and get that under control. I would not, the banks. Wells Fargo used to be one of the primary mortgage lenders. They weren't somebody you went to establish a mortgage, but they seemed to buy up all the mortgages, and that's not happening so much anymore. But some of these things I don't use the banks for. What I do use them for, or what services are important, and again, it's dependent upon you, but it's probably going to be these bottom ones. I don't care about the interest rates because I'm not getting a loan from them, nor am I typically relying on them for interest. So if you're buying, whatever, snow machines or vehicles, maybe you're more interested in that with the local bank rates. But car payments, like I said, are not a great thing. So today's interest rates, I just pulled these off. And so, what's going to happen here is this was a national comparison. So you're going to have all these banks that are probably a little sketchy here at the top because they're offering maybe a teaser rate to kind of build up some clientele. So Bass, Tab, Bread. I mean, it's not till you get down here a ways before you start to even hear of some of these banks. Ally Bank, if you're familiar with them, it's probably been 5-6 years ago. They used to be GMAC, like General Motors. They had such a bad name that they were able to abandon their whatever. They chose to abandon their old name and come up with a brand new name. So not really a testament to how loyal their customers. They decided it was better off to just give all that away and switch names. Synchrony is kind of a startup bank in the Midwest. I bought a piece of equipment and ended up with a loan through them. They were fine, but they're just, I think they're based in somewhere in the Dakotas. Anyway, now we start getting down here in the banks that you've heard of, Capital One, Discover, and then down here at the bottom. Go figure, at the bottom. But anyway, look at their annual percentage yield, 0.01. So they're not even making the pretense that you're really paying you interest. These are fractional. This is not, a percent. This is 0.15 of a percent. And so go figure, you put a whole bunch of money in there, and inflation was at 9.1. This was back in June, but you can see the math doesn't add up. Over the course of a year, you're essentially getting nothing for interest over here, and the buying power of that money is being just devoured. So inflation typically, when we thought about it, was 2 to 3%. Typically 3%. We'd been in pretty low inflation here for years, but now we're off the chart. I mean, 9, it would be up here at the almost off the chart. So we're definitely in a time of high inflation. And again, 40% of the money ever created in the world's been created since whenever. It's scary, the amount of money's been created. This quantitative easing, this was the Fed, just, money machine goes burr. They're just cranking money out and flooding the market, trying to stimulate the economy, trying to keep things going, and pretty soon you do this, and then you hyperinflate, and the wheels come off the bus. So the Dow, on the other hand, this is just regular stock market, and this is just a broad range index, basically about 10%. And it's, you're going to have, the Great Recession back in 29, but go figure, it got up super high, and then it dropped, but then it kind of eased its way back, and took a while, but it gets back, and, there's blips along the way, but if you're in it for the long haul, if you're in it for a career of savings, this will work. This is not 0.1%. This is about 10% per year. So, because there's a bit of logarithmic in here. Okay, so enough of bad mouthing the banks, but again, banks are what they are. They're very useful. Not a good place to keep large amounts of money. And so this is where we're talking about money management. Series of decisions made about cash inflows and outflows. Liquidity is what banks offer, the ability to get to the cash quickly. Credit cards for liquidity, great, but they have to be paid off. They have to be available. A credit card that's maxed out is not doesn't present any utility to you at all. Checking account, yep, very liquid. Overdraft protection, great. Stop payments, not so useful anymore. Floats don't really happen. What you can use a stop payment for is, let's say, and this has happened to me, where I took somebody's check for a payment and I lost the check. And so now, I've got to ever put my tail between my legs and admit to them that, hey, I lost that check. Can you write me another one? And most people are like, well, no, because if you find that other check, you're going to cash it, and then we're going to be out. Now, they know I probably wouldn't do that, but to comfort them, yeah, I, called the people and I said, look, I'll pay you the $5 or $10, whatever your bank charges you to issue a stop payment. So it's a hassle for them a bit. They got to go to the bank and they say, okay, this check that was written, on such and such a date, please put a stop payment on it, which means that bank can, that check, if it's presented, can no longer be cashed. Well, obviously, since, I lost it out in the field somewhere, it's not going to be cashed, and then they can, with full confidence, write me a new check, and everything's good, and I reimburse them for their fee, so that's good. Direct deposit, I addressed that. This is kind of the way things are going. There's going to be more and more digital transfers, and there's probably going to be some central digital currency, which is kind of horrendous for a lot of reasons. But anyway, there's really no way of stopping that. Bitcoin could obviously help, but that's not the preferred government solution. So we'll see what happens. Fees and no interest on most checking accounts. And again, that's not a showstopper for me because I'm not looking to get interest on my checking account. I don't have that much money in there. Now we get into kind of marketing terms, negotiable, or there's no federal definition of a NOW account. It's just some bank, came up with this name. Anyway, you definitely will have money market accounts or asset management accounts or whatever they tend to, define them as, but it just means an account that is used for cash management. If you're buying and selling stocks or mutual funds even, it's helpful to have a cash account. So when you want to buy some mutual funds, for example, if you don't want to buy them all that day, it goes into an account that's just a cash account. And if you sell something from your mutual funds, and it goes back to that cash account, but it's just sort of a parking place. And it tends to earn some interest, but it doesn't have a lot of withdrawals or even deposits in it traditionally. So it can earn a little higher interest rate because there's not a lot of activity in it. All right. Certificates of deposits. So what you're giving up here is you're giving up some freedom in terms of time frame. Choice amongst maturities. Maturities could be 5 years. So you're taking an interest rate, but you're locking that in for a certain number of years. So it eliminates some of the risk for the bank because they aren't paying you an interest rate, or thinking that you're going to be pulling those funds out. So the transaction costs are lower for them, and they have a little bit more security, so they offer you a little higher rate. Again, another marketing term, money market demand account. Less liquid than a checking account. Sometimes they have limitations on how many withdrawals you can have per year, or per month, or whatever their thing is. Not a lot of activity, not a lot of fees associated with it. Treasury security. So again, they're going to pay a fair interest rate, but not a lot because the underlying securities are very stable. You're not exposing yourself to very much risk. So, but you can keep cash in there. Money market funds, similar to the others. Again, these definitions don't equate. When they say typically less, that these bank policies could change. Commercial paper, commercial paper means that it's issued by a large corporation. So there is some security since it's a big established corporation, but it's not like a T-bill. For most cases, though, I'd probably go for that because I want a little higher interest. I want to exceed inflation. And here they're just going to show some sample rates. Asset management account, sweep account. So this gets back to this notion of the sweep account when you sell, say, some stocks. If you're actively trading stocks, when those stocks sell, those funds will be settled in that account. Or if, say, you get a dividend from a stock you own, those dividends will maybe end up at a cash account. Although you could also label your mutual fund to reinvest those, which is also probably the better way to go. So they're going to split out all these different things, but you aren't going to even find these definitions very consistent across the industry. And it just depends. So the advantages and disadvantages may change. You're probably going to find a hybrid. But it just means an account that deals in cash that's typically associated with a brokerage firm, except for a savings account. That would be with the regular bank. And you can get some of these lower level ones maybe with a bank, but not going to be the same interest rates. So this is what they're showing. If you're willing to give up the liquidity, see the liquidity chart is very low here when you're tied in, but the return is a bit higher because you've made a commitment. Less commitment, it's all different things. Checking account, no commitment. You can pull that money out whenever, and your return is, not good. So, credit risk, interest risk. So this is what determines the risk to the bank, and this is what determines how much interest they're going to pay to you. CNN, they're barely existing right now, but there's better sources for that. Although there are financial channels out there, but there's certain big names out there. Kramer, for example, who tends to be on the wrong side of everything. So you have to be very careful to make sure that these people are working for you. And especially you'll see some of these that are, always telling you gold is the greatest thing ever, and then you see that they're sponsored by gold companies, people selling gold. So you have to make sure that you're getting advice that is completely unbiased, which is quite difficult, especially if you're getting it for free. Somebody is paying for it. Impact of expected economic conditions. So again, this could be a time to allocate more funds to liquid investments. Yeah, if you had more funds. Obviously, it's a tough time, and anyway, the savings rate right now is pretty horrendous. People are not, living paycheck to paycheck. They're just trying to get by. They're hoping for better things. But yeah, things are not good. So, jumping right to the weak economy. Yet, greater potential for layoff, income may be reduced, sources cover expenses. So, a lot of people are hunkered down right now. The days of very low interest for spurring on, especially the tech sector, that's kind of pushed on. So, hopefully things will change. But 2023 does not appear to be a promising year. Technically, we've been in a recession. Recession is defined is 2 consecutive quarters of GDP loss. So when people say, well, we may enter a recession, they're already expressing a fairly partisan view. We've been in a recession. whether it's going to get worse or not is the only question. Most people are expecting it to get worse. So, always consider the risk trade before making investments. Money market largely free from credit risk. Yes, they are. Do some credit risk since they may hold commercial paper, meaning that the commercial paper that the companies may default. But again, not typically a problem. You'll see the interest rates are they deal with large corporations that are typically not very risky. So again, it's about money management. So the way I would set this up typically is to have your checking account as your utility account, and as the funds in that account, maybe they exceed a certain predefined level, say $4,000 or $5,000 or something like that, whatever it takes to get you through the month. When they exceed that, you perhaps would transfer to a brokerage account with a different firm, and this other firm would have very few transactions, mainly incoming at this point because you're trying to accumulate wealth, and also some restrictions on outgoing transfers. I mean, you can pull money out of these accounts, but you may have to do at least some sort of two-factor authentication and some other things. You're not just going to open up the account one day and find out that somebody made a debit and that can happen, especially in checking accounts, where just due to the volume, sometimes you miss the transactions, or sometimes the institutions allow, there's just more chance of fraud. In the big brokerage firms, there's not as much activity and fewer transactions taking place, and easier to keep track of, and you can put more holds on it. I mean, like the especially like in the crypto world, they're very aware of this. Most time you put something in a vault where the funds, if you sell something, they're not available for 24 hours. So you sell something, you get a notification through maybe a text, maybe an email, also letting you know that the funds have been sold, and you have a chance to intervene in case there's been some fraud. That's not going to happen in a checking account. Checking account, the money's gone and it's gone. So anyway, interest rates have been low. So again, they're kind of behind the power curve. Interest rates are actually climbing up, but inflation is really high. So I resist the temptation to reduce these investments. I would argue that money in a money market account is waiting to be invested, but it's not currently an investment in its current form, because these money market accounts, although they're stable, they're not earning more than an investment account, and they're not keeping up with inflation. So I would not consider that an investment. Anyway. But long-term investments, and again, it doesn't have to be all stocks. It could be, real estate is tremendous. There's other things out there. There's big mutual funds that are not going to get you the high yields, but then again, they're not going to go down. They're not going to go in the toilet, and there might be a middle ground. Not all the stock market is the same. If you study, and don't get greedy, you can come up with something that's within your risk tolerance. But to keep it in a savings account within a bank and just accept the fact that it's going to get eroded away by inflation is just that you just can't do that. You just will not get ahead with that sort of strategy. So when I talk about some of these big banks, I talked about the banks locally, and then when I talked about some of the brokerage companies, Fidelity, fine. I've got accounts with these guys, but I'm not Shillenforum. I think they're based in Boston primarily. You've got Vanguard. You've got you can go down the whatever you're familiar with. TD Ameritrade's. They're actually started out in Canada, but now they're mainly based in Omaha. You've got T. Rowe Price. You've got so many big companies that offer so much more. They don't do they tend to do some banking, maybe a little bit, but they'd be kind of clunky for that. But what they do is they do a lot of this investment type stuff. So if you had a local bank for convenience and for ATMs and all that, and then you had some sort of allocation to one of these bigger investment firms, a brokerage firm, or perhaps if you just skim the money off when it hits a certain threshold and put it in one of these larger firms, you would have that separation, that sort of air gap that would provide you the security, not only from identity theft, but also kind of a psychological separation that the money, once it goes into these accounts, it's associated with some sort of long-term investment, and it's not something you're going to pull out to blow on something impulsively. So anyway, and then there's just so much more that these folks can achieve for you, and the interest rates are going to be higher. So again, there's a ton of companies out there, but in terms of the big brokerage firms, no, they're typically not going to be local, but you're not relying on them for local events. The term project, I just want to touch on it fairly early in the quarter. I mean, we're fourth week now, but it's in the syllabus. So we're about a month into the term. I'm not looking to, I'm not trying to be some voyeur. I'm not curious about your personal details or what your plan is, because number one, it's even if you told me exactly what you plan to do, it doesn't matter, because life is going to intervene, and it's probably not going to go the way you thought it was going to. There's also some of you that are already kind of immersed in your career, perhaps, and you're already working on stuff. And again, I don't need your personal data, but so for some of you, depending on where you're sitting in life, it could be just a complete forecast. For others of you, it would be a sort of a person that's very similar to you in terms of their financial setup, and how would you help that person get ahead. And just pick a name for them and say, this is what this person's going to do. And then you're going to run through all the elements of personal finance, most of which we're going to touch in the class. You're going to tell how you're going to get ahead in life, how things are going to happen. College savings for kids, what's going to happen in terms of insurance. Are you going to be under a huge student debt load? How are you going to deal with that? And is that going to delay everything going on? Know what you're getting into with Social Security. Is it going to be there for you? And if it is there for you, is it really going to be that much money? Social Security people, they'll be up front with you. They'll tell you it's not a whole lot of money, And oh, by the way, it's probably going to be less by the time you get there. So don't think that, I don't have to worry about retirement because I've got Social Security. It's not going to be a good retirement. The life insurance, you've got options out there. When you need insurance, and I'll tell you what, again, this is completely opinionated on my part, but you don't need insurance when you're older because it's incredibly expensive. Yeah, you need insurance when you've got a lot of expenses, and when you've got a lot of people dependent upon you. Life insurance is not for you. It's for the people they're going to be supporting you, that are at risk. But if you're typical retirement age and you had kids, your kids are already, that ship sailed. Those kids are either are on their own, knocking it out of the park, or they're not. But more money through life insurance is not necessary really at that point. Look at how much you expect to get in your career. We'll talk more about this as we go. Military could be a big part of it if that's the way you're going. There's the vehicles, 401ks, 403bs, thrift savings plan, the military version. Anyway, a lot of different stuff, but read through there and kind of try to develop an outline. For those of you that are really stressed out about this, don't be. Um, I do this every term, and I have people send me a draft of their plan. You know, sometimes they just send me an outline, but a lot of times they'll send me 4 to 5 pages ready to go. And I'll tell them, yeah, you can submit this right now and you'll get an A, or you can submit this right now and you'll get a C. This is kind of what you need to change. So if you don't get an A on your paper, it's on you completely. You can get an A. You could send me a sample paper, and I could tell you what you need to do to get it up to an A. So it won't come as any mystery to you if you don't get the grade you want, because the offer's out there. Anyway, that'll become more relevant as we get later in the term. Evaluate 3. This is your homework. So I said 3, 4, whatever it takes. Look at your checking options. This assignment is not in the book, right? So, your own bank, and then look at a couple others and just see what they charge. And it could just be maybe some sort of Excel type spreadsheet, where, location, fees, something, and just categories, and make sure that the bank that you're associated with is really earning your business and not charging you a lot. Just because you had a great bank one time when, maybe things have changed. I've mentioned this a few times where, companies kind of have a lifespan, and they tend to be real good at first and gain market share, and then get kind of complacent, and then just kind of ride it out. And that riding it out phase means that they're not really concerned about the customer, and they're just making their money off people who are too lazy to change. So anyway, and then you'll just decide, I decided my own bank's the best because I've always dealt with them. I like the people there. Their fees are about average, and the ATMs are convenient. Or I don't use ATMs, so I don't care. Whatever your criteria is. So anyway, it's kind of personalized. But that's the homework assignment. And that's it. Till next week.